Hello everyone, my name is John Locke and I'd like to welcome you to the winning trade, but first, the required disclaimer. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors and we're not making any specific trade recommendations. Please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note that in the presentation we're doing hypothetical computer simulated trades and the results. They're believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. All right, if this is your first experience with us, my name is John Locke. I'm a trading performance and success coach with Locke in Your Success LLC, and myself and my team help traders win in the market and in life as well. And today I'm here to guide you into the realm of high probability income trading. Now in a moment we're going to be going over the winning trade, but before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning that we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they might be otherwise. Now when you find that you want more information as you're following along, simply contact us at lockingyoursuccess.com or ask a question in the comments on this video and we can direct you to where you can find more information. So let's move on. The trading strategy we're looking at today is from our X4 series of trades, and it's called the X4 version 14, or V14 for short. This is a conservative broken wing butterfly strategy that we trade on the SPX. The position lasts about 60 days and requires a minimum capital of $2,250. For the example size, we're going to use something 10 times that. We're going to call it a 10 lot. And that is going to have a planned capital of $22,500. As far as risk management, the V14 has a high profit target of 11.1%, and if certain things happen throughout the trade, we're going to reduce that profit target to 6.7%. The exit loss trigger is also 11.1%. In this particular trade, that equates to a profit target of $2,500. And if certain things happen, that may be reduced to $1,500, and the exit loss trigger is going to be $2,500. So let's take a look at the position. So for this position, we start 77 days before expiration. And if we're looking at the November expiration, 77 days puts us at Friday, August 30th, 2019 for an entry date. Now, this position here is a broken wing butterfly strategy. And it's a strategy that starts with its long strike very close to the asset price. So the current asset price on the S&P 500 right now is going to be 2,923. The closest strike that we have, or the closest 10-point strike we have to that level, is going to be the 2,920 strike. So we're going to buy, in this case, 10 options at that strike. We're going to go down 40 points, or 40 points to the strike of 28.80 and sell 20 of those. And then we're going to go down 60 points and we're going to buy some 28.20s. That's going to give us what we call a broken wing butterfly, or a vertical spread that's bearish on this side and a vertical spread that's bullish on this side. And that's going to give us what we call a certain delta number. So let me take out this here, and that's taking out the put. If we take out that put, we have a position delta of 17.37. If you've watched these before, or if you haven't watched these before, let me talk about this quickly for a minute. We have the asset price of the S&P 500 that comes along the bottom. We have our profit and loss along the side. We have our expiration graph, which is the dark blue line here, which is the value of the position at any given price point of the SPX at expiration. And then we have this red line that transitions into this light blue curved line. That's called our T+0 line. And that gives us our position profit and loss, or projected position profit and loss numbers as of today. With that line, we have something called the Greeks, and one of the Greeks is called delta. And in this case here, we have a delta of 8.95. Essentially, that means that the position is projected to gain $8 with a $1 up move and lose $8 with a $1 down move. These are theoretical numbers, and that isn't necessarily going to happen that way, but it does give us an idea of what should happen, and we also use this number to base adjustment points off of very often in a lot of these types of strategies. So that is our delta number right now, 8.95. If we take out the put, our delta number is 17.37. So in this strategy, we're going to enter the 60-40 broken wing butterfly. We're going to check our delta. And if it's over plus 10, then we're going to want to do something about that to the downside. So what we're going to do is we're going to try to get it under 9. And to do that, I can buy this 8 delta put, or negative 8 delta put, you could call it. And that's going to shave off our delta number and bring us down to 8.95, which is under 9. And that works as a starting position for the strategy. Now from here, if we get down under the short strikes, we are going to take this position and roll it back. If we start taking on too much downside risk for this T plus 0 line, in other words, if we say have a 100-point down move and it looks like that down move is going to create a loss of greater than $5,000, then we will make some adjustments to the downside with puts and so forth to manage that downside risk. To the upside, we're waiting to go negative delta. We have certain negative delta limits within the trade, which we don't hit inside the tent. But if we get past 30 points past the long strike, then if we're negative delta at all, we're either going to roll the more than, I guess, -1 negative delta. We're going to roll the position, or we're going to adjust the position or make an upside adjustment to the position so that we can make this maybe a little bit more profitable to the upside. So let's just go ahead and we'll take a look at how this position goes. And what I'm going to do is I'm just going to move ahead 10 days. Now this is a fairly long-term position. We start 77 days to expiration. We're going to exit this position regardless when our January gets 77 days to expiration. So that's going to be about 63 days. So we're probably going to be in this position 63 days unless we hit a profit target or unless we hit a exit loss trigger. So let's just move this forward a week at a time. So let's go to, say, the 13th of September. So as of the 13th of September, we end up getting an up move, and this position ends up having a profit or loss of positive $874. So everything's going fairly well. As long as we have positive delta here, we're not going to do anything. We're just going to let this go. And if we look at our price charts, we started on August 30th, which is back here. We had a bit of a down move the first day, and then we had a fairly aggressive up move. Let's move this ahead, say, another 2 weeks. Okay, we go another 2 weeks, the market starts to pull back a little bit. If we take a look at our risk profile, we can see that we lost some of those profits, and we ended up being only up $149 at this point. That can happen for multiple reasons. If you went back and looked at this expiration graph, we really shouldn't be down or shouldn't have lost that much money with that type of a down move. But what tends to happen sometimes is we have this thing called implied volatility, and that pushes this line around more than we expect from time to time. And this is one of those cases where the implied volatility in the market is rising quite a bit. If we go ahead, say, another 2 weeks, and I look at my price chart, let's see, let's just go to the bottom day here. Actually, let's go to October 1st and 2nd because that might be interesting. That's where the market bottoms out. If I go to October 1st, we start going down, but it's nothing too bad. We're at about break even at this point. We had a volatility, what we call a volatility event on Wednesday. If you look at this, if we get a down move of, say, I think it goes down 45 points the next day. This is projecting, if you look at the little box underneath the arrow, You can see a minus 660. This is projecting this position is going to be at a $660 loss with a 45-point down move. If we go to the next day, we actually realize that move. And we end up being down more than that, like $1,016. Now we have a maximum loss of $2,500. This really isn't a problem. The reality is, according to the Greeks or the analytics in the model, this should be up money at this point. And normally, when we have a market move like that, that would be true. But in this case here, like I said, we're having a bit of a volatility event. So this is drawn down more than it really should be. That being the case, not really an issue here. If I take this here and I go down to 27.94, this drawdown is only $3,000. This trades well within specs. It's above its maximum loss. Its downside risk is under control. Not really an issue here. Okay. If we move forward another week, the market starts to bounce out a little bit and we start to recover. Now, if we move ahead from here another couple of days here, you can see we start to gain money very, very quickly. If we get all the way until October 15th, what ends up happening is we end up being more than 30 points over the long strike, and we end up being more than -1 delta. In that case, that triggers an adjustment for this particular position. And we can adjust it in one of two ways. And it kind of depends on what the implied volatility situation is doing, but I'll kind of show you here. So one way we could do it is we could take this upper long and roll it back, and in combination with that, take this lower long and roll it up, basically making shorter wings on the upside and the downside. What that will do is that gives us a little bit more profit potential. So our profit potential goes from being here at $1,800 up to $2,400. But unfortunately, in this case, that also is going to reduce our profit target. So that being the case, we could either take this at a profit of $1,800 and close the trade and call it a day, or we can take a look at and see if it's going to allow us to do what we call a roll-up. So if we do a roll-up, what we're going to do is we're going to close the position that we have, and then we're going to move it. So in this case, what we would do is we would take it and go back to what we call starting position. So here, let me just bring the trade in. We remove that trade, we put our long strike near the asset price, we're at $29.98, the closest 10-point strike is $3,000. We look at a 40-point wing and a 60-point wing. If we can enter this position as is normal, then we can go ahead and continue to trade this. And in this case, we can. We come in here and we're positive 4 delta, and that's within our normal entry guidelines. And if we go with a down move of 100 points here, we're at a $2,000 drawdown. So again, that's within normal entry points. So at this point, we're allowed to do the roll-up. If we want to go for more, if we want to go for a high profit target, then this is what we need to do. So here, if I go into the 16th, then the market pulls back a little bit. No big deal. If I go to the 17th, we're up about $2,080. If we go to the 18th, no change. Go to the 21st, we get a nice 19-point up move, and we get a nice increase in our profits. Our volatility went our way in this case, and we have a profit of $2,583. At that point, we've hit our high profit target. We would want to exit the trade, and after commissions, we'd end up with approximately $2,543, and that's going to be about 11.2%, a little bit over our profit target number. And it would also be the conclusion of our trade for November expiration. And that was the X4 version 14. This episode's winning trade. If you like what you see here, I encourage you to join us and discover how you too can follow along with this and many other great strategies as they unfold during our weekly Options Trading for Income webinars, and where you can also learn about upcoming trade presentations as well as our Trading Success Blueprint. And perhaps best of all, you can get information about our free Trading Performance podcast, where you can learn to become a much more effective trader regardless of the type of trading you do. If you have any questions or comments or anything you'd like to see on the next winning trade, we'd love to hear from you. Simply comment on this video below so you can get those questions answered for you. And we would also encourage you to come on over to thewinningtrade.com where you can find past episodes of The Winning Trade as well as a lot of other fantastic bonus information on how to profit through income trading. And please remember to subscribe and share this episode, and also to comment on our YouTube channel where I will personally answer any of the questions you may have. Thank you, and we will see you on the next Winning Trade.